Let's prepare an income statement using the contribution margin format. Under the traditional approach, costs are organized by function on our income statement. This is in accordance with GAAP, generally accepted accounting principles, and is used primarily for external reporting purposes. We'll take our sales, subtract our cost of goods sold to arrive at our gross profit margin. Then we subtract our operating expenses to arrive finally at our net operating income. Under the contribution margin approach, rather than classifying cost by function, we will classify cost by behavior. We take sales, we subtract off our variable cost or variable expenses to arrive at our contribution margin. From there, we subtract our fixed cost to arrive at our net operating income. Our contribution margin approach is used primarily by management for internal decision-making purposes. For instance, we'll find our contribution margin format is useful for performing cost volume profit analysis, a topic in Chapter 6, when preparing budgets, a topic of Chapter 7, and evaluating or making special decisions such as pricing or performing make or buy analysis. Again, our contribution margin approach makes use of our knowledge of cost behavior to prepare a more useful income statement for internal decision-making purposes. Let's look one more time at our contribution margin format. Again, we classify cost by behavior. We take our sales revenue, we subtract our variable cost of $60,000 to arrive at a $40,000 contribution margin. This represents profits or funds available to cover our fixed costs. Once we've covered our fixed cost, whatever is remaining, if anything, is referred to as our net operating income. We'll find that using our contribution margin format, we most typically also calculate our sales revenue and variable cost on a per unit basis. We'll do this by simply taking our sales revenue, dividing it by units sold, and our variable cost, dividing it by units sold. And we'll find the knowledge that we make a contribution margin of $20 per unit very useful in making decisions regarding pricing, special orders, and other types of decisions. Let's take a look at a quick example for the Alpine House, Inc. It's a large retailer of winter sports equipment. We're given an income statement under the traditional format for the Alpine House, Inc. We've got sales minus cost of goods sold gives us a gross margin. Then we subtract our operating expenses, finally to arrive at our net operating income. Let's take our traditional income statement and some additional information given in our problem and prepare a contribution margin format income statement. We're told that skis sell on average for $500 per pair, and our variable selling expenses are $40 per pair of skis. The remaining selling expenses are fixed. The administrative expenses are 30% variable and 70% fixed. The company purchases skis from an outside supplier for $300 per pair, and in the most recent quarter sold 300 skis. Let's prepare a contribution margin income statement for the quarter and compute the contribution margin per unit or per ski. Let's begin with sales. Our sales under both the traditional and our contribution margin format will be identical, which is our $150,000. We can pull this directly off our traditional income statement or calculate it as our $500 per unit selling price times 300 skis. Our cost of goods sold, again, comes directly from our traditional income statement or can be calculated as our $300 cost per unit times our 300 units sold. Our selling expenses, we're told, are $40 per unit. Multiplied by our 300 skis gives us $12,000 in variable selling expenses. Our variable administrative expenses, we're told, are 30% of our total administrative expenses. In our traditional income statement, we're told that administrative expenses are $10,000. So $10,000 times 30% gives us variable administrative expenses of $3,000. This gives us a contribution margin then of $45,000, which is simply our total sales of $150,000 minus all of our variable cost, $90,000 in cost of goods sold, $12,000 in variable selling, and $3,000 in variable administrative costs. Our next step then is to calculate our fixed cost. Our fixed selling expenses will be $18,000. This is our total selling expenses according to our traditional income statement, minus the $12,000 that was variable component. Our fixed administrative expenses will be $7,000. This is our total administrative expenses of $10,000 multiplied by the 70% portion that are fixed. This gives us a net operating income of $20,000, which is simply our contribution margin of $45,000 minus our fixed costs of $25,000. On a per unit basis, we were already given our selling price, our cost of goods sold, and our selling expenses. Our variable admin expenses per unit are $10 per ski. We calculate this by taking our total variable admin expenses of $3,000 and dividing it by our 300 skis. This means that our contribution margin per unit or per pair of skis sold is $150.